The S&P 500 just witnessed a concentrated liquidation of high-multiple software stocks that wiped out $400 billion in market cap in a single 48-hour window. While the headlines scream of a systemic collapse, the bond market is signaling something entirely different. A violent tactical rotation where capital is fleeing 30 times revenue AI plays to find sanctuary in defensive value and cash flow-heavy industrials. Good evening and welcome to the CFO Suite Global Intelligence Briefing. The volatility we are witnessing is not a broad-based rejection of equities, but rather a surgical repricing of the AI premium. Investors are moving away from the growth at any cost narrative that propelled companies like Palantir and Snowflake to astronomical valuations earlier this year. We are seeing a specific divergence where the Mag 7 dominance is splintering. While Nvidia continues to print 60% gross margins, the secondary tier of SaaS providers is facing a brutal valuation reset as enterprise buyers scrutinize the actual ROI of generative AI deployments. The rationale for this sell-off is rooted in the AI disruption gap. Major cloud hyperscalers, specifically Microsoft Azure and AWS, are reporting massive CapEx increases, but the trickle-down effect to application layer software has stalled. This has created a vacuum. When you look at the internals, the Russell 2000 has actually shown pockets of resilience, and the credit spreads on high-yield corporate bonds remain remarkably tight. This tells us the plumbing of the financial system is intact. We aren't looking at a 2008-style liquidity trap. We are looking at a 2000-style high beta purge. To understand the trajectory, we have to look at the yen carry trade and its lingering effects on global liquidity. The Bank of Japan's recent hawkish tilt has forced hedge funds to deleverage, selling their most liquid winners, primarily US tech, to cover margin calls. This forced selling is hitting the Nasdaq 100 disproportionately. But if you strip away the top 10 holdings, the median stock in the S&P 500 is trading at a much more reasonable 18 times forward earnings. This is the moment where institutional discipline separates the winners from the victims. While retail sentiment is hitting extreme fear levels on the VIX, which recently spiked above the 35 level, institutional smart money flow trackers show significant dip buying in oversold energy and healthcare sectors. If this level of institutional analysis is giving you an edge in this volatile tape, hit that like button and subscribe. We do this every single day to keep you ahead of the curve. The pivot point for this market remains the Federal Reserve's terminal rate. The market is currently pricing in 100 basis points of cuts by year-end, a move usually reserved for an economy in a tailspin. However, with unemployment still hovering near historic lows and GDP tracking at a 2% clip, there is a massive disconnect between the Fed's higher-for-longer stance and the market's save-us-now expectation. This tension is what's fueling the intraday swings of 2% or more. Looking ahead, the catalysts to watch are the upcoming quarterly filings from the Tier 2 networking and semiconductor equipment manufacturers. If companies like Applied Materials or ASML signal a slowdown in China-based demand or a cooling in the HBM memory cycle, the current sell-off could deepen into a structural bear market. However, our current modeling suggests this is a healthy, albeit painful, flushing of speculative excess. We are monitoring the 10-year Treasury yield closely. As long as it stays anchored below 4.5%, the equity risk premium remains justifiable for long-term allocators. We are maintaining a neutral outlook on this volatility with a 65% confidence score, as the technical damage to the charts will take weeks to repair, even if the macro data remains stable. If you want to ensure you never miss a deep dive into these market-moving dynamics, make sure to subscribe and turn on notifications. This analysis is powered by the CFO Suite. For more institutional-grade financial intelligence, visit thecfosuite.ai. This content is for informational purposes only and should not be considered financial advice. Always consult a qualified financial advisor before making investment decisions.